Hello, everyone. Welcome into Above My Pay Grade. My name is Eric. Thanks for tuning in. You could hit that like button, hit subscribe. Really helps out the channel. Thanks a bunch. So a lot of you have probably heard about what's going on in England and how they had to reverse course from quantitative tightening and tightening monetary policy to loosening within a week. I wanted to kind of explain that in layman's terms because it helps me understand it too. I want you to imagine that you are a pension fund manager. So you're the bigwig, smoking cigars, lighting them with $100 bills. But you manage this pension fund. You don't want to take a lot of risk. And traditionally what pension funds have done is they've had some kind of allocation of bonds and stocks. And bonds have paid out fairly well over the last 40 years. Why? Because bond yields, meaning if you go into a treasury market and you want to buy government debt, those yields have been going down over the last 40 years. And every time they go down, that means the bond you bought previously at a higher interest rate price went up. That's right. Price went up. So that meant that your fund was doing well with that allocation of bonds and stocks. Now, as you probably know, government treasuries, and I'm using those synonymously, bonds and treasuries, but as you know, government treasuries have a very low yield, or have in the last 5 years, 1-2%, give or take. Okay, and that beat inflation, beat CPI, but it didn't help these pension companies out because these pension funds have to make about 7% a year, and they want to take as little risk as possible to make that 7%, to take that 7% and pay out their beneficiaries. So if they start digging into the honeypot, which is the money they use to make yield, then that is a vicious cycle. So what these pension funds did, they looked at the treasury market and they're like, hey, these are yielding like 1.5%, and we need them to yield more in order for us to make our 7%. The cool thing about low interest rates, though, is we can borrow from the banks at, let's say, 0.5%. So we can go to the bank and say, give us billions of dollars at 0.5% interest rate, because the banks are getting it at 0. And then we could take that money and buy government debt, treasuries yielding 1.5, 2%. And that delta between what we're paying the bank and what we're making on the treasury, it's a win-win. It's nothing but just cash flow. But in order for us to make a lot of money, we got to lever up a lot. So we got to borrow a ton of money from these banks. It's a risk-free trade, borrowing money from the bank. We're buying a treasury, which is like the most risk-free investment you can make. It's great. And so that's what they did. They bought a bunch of treasuries yielding next to nothing, but they were yielding more than the interest they were paying. All fine and dandy. Seems to make sense. The problem is, if you bought a treasury and the yield goes up, yields are going up, that means the one you bought, let's say you bought a treasury, for ease of figuring, or let's say you bought a treasury $100 and it yields 1%. That means you're making $1 every year. And treasuries, or as they call them in Europe or Britain, gilts, so that treasury yield was 1% when you bought it. And treasuries start going parabolic, meaning the interest rate starts going way higher. So let's say it's at 5% like it was in England. That means somebody can take that same $100, buy a treasury, and make $5 a year. So the one you have is $100 making $1 a year. The one they have is $100 making $5 a year. If you want to make the treasury you have, and it's a liquid market, you could sell this contract to somebody else. But if you want them to buy it, you have to make it worth their while. And the only way for you to make it worth their while, since you have $100 that's yielding $1, you have to drop the price. You have to drop the price because they could go out in the market and spend $100 and make $5. Hopefully I'm making sense here. All that to say, this leverage in the system, in the pension system, when the interest rates went through the roof, these banks they start looking at the balance sheet of the pensions like, I think they're not going to be able to pay us back. So I'm going to want our money back to now. And what do they have to do? What do these pension funds have to do? Sell. They have to sell the treasuries or the gilts in England. They have to sell at a loss to get that liquid capital and give it back to the banks. Translation, they cannot pay their beneficiaries. And more than likely, they're bankrupt. That is not good for the voting public. And that's what broke in England. And that's what's going to break probably all around the world to some degree. The question is, will it happen in the United States? I'm reading from an article here from Zero Hedge. And the interesting thing about what happened in England, you're going to hear the word probably temporary and transitory and things like that. Like, this is not a long-term thing. Let's calm the market down. And that's what England said. They said this is a temporary quantitative easing measure that's supposed to stop on the 14th. Okay, so in a couple days. And if you look at this chart, you saw how the European or the English gilt market went parabolic. They stepped in, started doing quantitative easing again. And would you look at that? The yields are going way back up. Why? Because they know they're stopping on the 14th. How much money do you want to bet they're not stopping on the 14th with charts like this? Probably not. But what does this mean for the United States? So far, the pension funds and the insurers have not dealt with the same margin call. But even if a pension did not take on a ton of debt to buy government bonds, here's something to think about. As interest rates fell, the pension funds in the United States shifted their real income earning assets like commercial real estate, or shifted to real income earning assets like commercial real estate, because they have to figure out where they're going to get yield. They have to get yield somewhere. So they started buying commercial real estate, and we all know how well that went. People are now working from home. Commercial real estate is in the toilet. The value of commercial real estate investment companies in the U.S. stock market have fallen by 35%, about the same as the NASDAQ. Depending on which survey of pension fund asset allocators you believe, the average U.S. pension has probably lost more than 20% of its asset value this year. So if we have a real bear market like we seem to be having, and these pension funds are having to dig into their coffers to pay out their beneficiaries, what that translates to is either people have to pay in more, significantly more, because they're losing the value of their assets in the pension. So the pension can't even make 7% anymore. And or these pension funds are going to have to cut. There's a lot of people out there who are solely reliant on their pension. They thought it was a promise or a guarantee. And it is not. It is not in the slightest. And even if you don't have leverage as a pension fund, even if you didn't take on leverage, if the real value of the assets you hold that you need to make income off of drop by 20%, that translates to you not being able to pay your beneficiaries. And it's not just companies or countries, it is the individual. This is mind-boggling. Credit card debt in the United States has gone parabolic. Americans are burning through this is another article from Zero Hedge, Americans are burning through their plastic in order to make ends meet in these inflationary times. Revolving credit, primarily reflected in credit card debt, rose by $17.1 billion in August. So it rose by 18.1% to put it in perspective. So that 18.1% increase, to put that in perspective, the annual increase, so in 1 month, by the way, in August, 18.1% increase of usage of credit cards. To put that in perspective, the annual increase in 2019 prior to the pandemic was 3.6. So in 1 month, we went up 18.1. In 1 year, in 2019, we went up 3.6. You do not have to be a mathematician to know that does not end well. Any of you who use credit cards, you know you can't just spend to your heart's content and not pay them off. And to add insult to injury, the average credit card interest rate has eclipsed the record high of 17.87 and is now 18.45. So if you are forced, it's not cosmic, if you're forced to use a credit card, that means you have no money. And so that means you're probably paying minimum payments. You're doing this revolving line of credit, getting more credit cards to pay off the last one, et cetera, et cetera. And eventually that road ends with you having tons of credit card debt at 18.45%, which is insane. It's probably something that will be hard to get out of. If in any way you can avoid, and it includes borrowing from family if you can, or just asking for a gift. Avoid using credit cards at this time. 18.45. If you're going to credit cards to pay your bills, you need to lower your bills, get an extra job, anything to avoid that. 18.45. But the bottom line is 30 to 60 million Americans are in that boat. How does that end? Not well. A lot of people going to declare bankruptcy. But if it's enough people, what really happens is the government steps in because they know that they can get votes by buying them. Okay? This chart will blow your mind. Look at the personal savings rate compared to consumer credit card debt. Right around June of 21, they started diverging massively. When does that break? I don't know. I don't know when it breaks. But there's just so much debt in our system. If we tighten it all, people take on more debt. They go to credit cards, or governments have to do more quantitative easing. And speaking of quantitative easing, another thing I was thinking about the other day, who's to say? Remember, treasuries is this market of government debt. Government sells this debt. And people, if they don't want to buy it, government has to raise the interest rate to incentivize more buyers. Problem is, as I've talked about ad nauseum on this channel, as interest rates rise, government becomes insolvent because they're already paying like $600 billion a year on interest alone. Okay, so government's the worst when they have 97 credit cards and they're all maxed out. So the treasury market is where that interest rate is set. So they cannot really have it go that high. So they can't have demand drop. So who's to say that the Federal Reserve, and there's a lot of people that think this already, Gregory Mannarino is one of them, without telling anyone, the Federal Reserve's going into the treasury market and buying. Who's to say that they have to make this huge announcement to the market and say, hey, just by the way, we're doing something called yield curve control, just like Japan. And that means that we won't let rates go higher than X percent because the government can't afford it. Who's to say that they actually have to make that announcement? And they can't just use special purpose vehicles because the Fed is clouded in secrecy as it is. They have the ability to print money, right? And they're a private institution, wink, wink. And they're federal and they have no reserves, yada, yada, yada. You know the story. But my point is, who's to say that they have to make this announcement? Why can't they do it in secret? It might be. I don't know. All I know is that I look at the things happening in England, look at those rates going up, look at credit card debt in the United States. This is all fairly predictable because we have a consumer-based, debt-based monetary system. And as soon as you tighten, the whole thing falls apart. You need more debt every single year to make the system run, which means inflation, okay? I don't know. This stuff blows my mind, that how bad some of these charts look. I'm like, wow. A lot of people said they couldn't kick the can down the road in 08, and guess what? They did. But this looks real bad. Let me know what you think in the comments below. Don't use credit cards. See you guys in the next one. Peace.